I'm Angie, and this is UK Money Wisdom. Today we're talking about something that many people worry about, but very few fully understand. And that is, how much is too much money to keep in a bank account? You've probably seen the headlines shouting, "Never keep more than £85,000 in one bank," while others say, "Keep everything in cash because it's safe." Meanwhile, millions of people leave large sums of money in bank accounts, earning very little interest. So today, we're running through 5 essential checks every saver should make. And for each one, I'm going to answer 3 simple questions. Could this apply to you? What could it cost or be worth? And what should you do next? Because there's no point learning complicated financial information if it doesn't affect your situation. And by the end of this video, you'll understand, number 1, when the £85,000 protection limit really matters. 2, whether inflation is quietly reducing your spending power. 3, if you're missing out on interest. 4, how savings can affect tax. And 5, how to organise larger sums of money more effectively. So let's start with the issue most people have heard about, because some people still leave large sums sitting in a current account, earning virtually no interest at all. And the first issue relates to the FSCS protection limit. And FSCS means Financial Services Compensation Scheme. Could this apply to you? And here's a table that will help you understand your situation. Because many people think having several accounts means they are protected several times. Often they're not, because several brands may belong to the same banking licence, and that's something that not everybody realises. This is why someone with £40,000 in one account and £50,000 in another account under the same banking licence may actually have £90,000 protected as one combined balance rather than 2 separate balances. And what could it cost you? This table will show you your potential exposure relating to each amount held. You see, most banks are very safe. The point isn't to create fear, it's simply to understand where the protection limits apply. And what should you do? Number 1, check your total savings. And number 2, check the banking licence relating to the bank. Number 3, review the FSCS protection. And 4, consider spreading larger balances. If you speak to your bank about this issue, here's a useful phrase. Could you confirm whether my accounts are covered under the same banking licence? It's as simple as that. Next, let's move on to another important consideration. Is your money losing value to inflation? And could this apply to you? This table will point you in the right direction. Even when money appears safe, inflation can slowly reduce what it will buy. We all know a pound today may not buy the same amount of goods and services several years from now. And what could it cost? Well, this table will show you the purchasing power lost over time, and it is a real issue. The danger isn't usually that money disappears. It's true that its spending power gradually shrinks, yes. So what should you do? Number 1, review interest rates. 2, compare alternatives. 3, do keep some emergency cash. And 4, review the situation annually. Now, number 3 asks, are you missing out on interest? And could this apply to you in this table? And if the answer is yes, then you need to do something about it. You see, banks rarely ring customers and offer higher rates. They just don't. Many people stay on older accounts, paying very little interest. And what could that be worth to you? Well, for example, if you look at this table, if you have savings of £20,000, 1% interest on that is earning £200, but 4% interest is earning 4 times as much, isn't it? £800. It's a difference of £600, and so on. And that's often where the real money is. It's not in hidden schemes, no loopholes here, simply checking the interest rate. And a few minutes comparing rates could potentially put hundreds, or even in some people's case, thousands of pounds back into your pocket every year. So what should you do? Number 1, check your current rate. 2, compare alternatives. 3, consider switching. And 4, review the situation annually, and do ask your bank which would be the better rate if you are in any doubt as to what to do. They will help you if you call them. Number 4 relates to savings, interest and tax. Again, could this apply to you? It covers interest under allowances, whether you have significant savings, and whether your HMRC tax code includes the interest estimate or not, and your ISA savings only, because many pensioners are surprised to discover that HMRC sometimes estimates future interest when calculating your tax code. And those estimates may not always match what actually happens. So it's worth checking with HMRC whether this is the case. And what could it cost you? Well, if the estimate is too high, your tax code may be affected. And if you phone them and ask them and the estimate is corrected downwards, that could be a potential tax reduction. And if your allowances are being used properly, again, potential savings here. You see, sometimes the issue isn't the amount of interest earned, it's the estimate that HMRC has used. If you let this go, it can take months and months to sort this issue out, so it's best to keep on top of it. Here's what you should do. Number 1, check your tax code. Number 2, review savings interest. You can check that with your bank or online, comparisons with different banks. And 3, contact HMRC if you need to. And a useful phrase is, I would like HMRC to review the savings interest estimate in my tax code. Now, number 5, you should be asking yourself, should all my savings be in one place? And could this apply to you? Do you hold large cash balances? Do you have multiple accounts? Have you had a recent inheritance or sold a house or other item or other large item recently? Because sometimes spreading money isn't about chasing returns, it's about simple organisation and reducing risk. And what could this be worth? Well, the benefit will give you better protection and peace of mind. Better interest, which could mean hundreds or thousands of pounds, and better organisation, easier management, which means less mistakes. Having a simple structure, you see, can make savings so much easier to monitor and much easier to manage. And as I said, you're much more likely to make fewer mistakes this way or forget things. So what should you do? Do list all your accounts. Do check your protection limits. Do review interest rates. And finally, decide whether changes are needed. If you only remember one thing from today's video, remember this. The question isn't how much money should I keep in my bank account? The better question is my money protected, earning a fair rate of interest, and organised in a way that works for me? Because sometimes doing nothing can quietly cost hundreds or even thousands of pounds over time. Have you ever found that out, either personally or through someone else's situation? And that's why these 5 checks are worth making. Do remember to subscribe if you found this information useful, and to be sure to receive my future videos. And also please share if you know someone you care about who could use this information. And finally, please remember my disclaimer that I don't offer personal advice. This is only general information, and it's based on current UK tax and savings rules and public guidance for the 2026-27 tax year. Because as we all know, individual circumstances do vary and rules can change. I hope to see you again in my next video, and in the meantime, be safe with your money and have a lovely day. I'm Angie, and this is UK Money Wisdom. Bye for now.